Hello and welcome to Econoday Unplugged on Tuesday, the 14th of April 2020. Mark Pender is stateside and I'm Jeremy Hawkins here in London. At the weekend, the so-called OPEC Plus group, that's essentially OPEC with Russia and Mexico added in, agreed to an unprecedented collective cut in oil production of some 9.7 million barrels a day, about 10% of global supply, and that to be introduced in May and June. In fact, Saudi, Kuwait and the UAE have all promised to make even deeper reductions than agreed. And the world's biggest producer, the US, will also be trimming its output. But oil prices are still struggling, and in large part, that reflects worries that demand could fall even faster. Just last Thursday, the IMF said it thought that the coronavirus pandemic would tip the global economy into its deepest recession since the Great Depression. And its new forecast, published just a few hours ago, shows world GDP shrinking 3% this year. That compares with a forecast of positive growth of 3.3% made just in January. And within this, the US is put at minus 5.9%, Japan minus 5.2%, the Eurozone a pretty awful minus 7.5%, with Italy at minus 9.1%, and the UK at 6.5%, but minus 6.5%. China and India are still shown to have positive growth of 1.2% and 1.9% respectively, but these are historically very low rates. And the warning is that things could be even worse. So let's have a look at what the latest numbers are telling us. Mark, any fresh clues from your side about just how bad the US downturn is going to be?
Well, I guess we're probably going to get those indications tomorrow with retail sales. This will be for the month of March, and also industrial production, which will also be for the month of March. What we've had out of the U.S. so far, as well as Canada, is employment data, which have just completely collapsed, and so it makes the assessment very, unpredictable. But these will be the first indications, retail sales being on the demand side for the U.S. and industrial production being on the supply side. So we'll be able to see what kind of a shock on each side is expected. Pretty much similar shocks by the Econoday consensus, which is -7 for headline retail sales. That's a monthly drop. That is gargantuan. And about -4 for industrial production, which is roughly the same because that's a volume measure. So they're both in the same camp, maybe 1/20th or some of a decline immediately. Sampling is always an issue here because it depends on what part of the month things are sampled in, and also responses are also difficult because you're more likely to get a response from a firm earlier in the month, and they may not even be home later in the month. Mm-hmm. So there'll be some uncertainty. So far, there's been some lower than usual sampling in today's import and export price from the BLS and also last week's CPI, I believe. But the statistics agencies are still, they haven't made any guesstimates yet on this data, and they're still releasing it as usual. So it's a little bit of a bumpy period as far as that goes, the sampling goes. And also how much this contraction is going to happen. I mean, these are IMF is guessing, and we'll get Chinese GDP on Friday, and the last I saw, it was a 6% year-on-year decline for the first quarter, and that follows an endless series of predictable 6% or incremental moves, slowing in growth. So now we're going to get a gigantic contraction. Then we'll really give you a test on the legitimacy of the Chinese data authorities. Well, it'd be interesting to see.
Yeah, I think I'm dead right on that. I mean, it really is going to be, I think, very much one of the focal points of this week, the China numbers. So I think they're talking about 6% down on the year and a possible 10% quarter-on-quarter contraction in GDP. And looking at it from what it seems to be the case is that we've got a lot of the larger businesses which have actually resumed work. I think they're talking about, officially anyway, somewhere between 80 and 90% or so. But there's still a lot of the medium and smaller size companies which are effectively continue to be hit by the lockdown. So it's going to be fascinating to see just how much of this is actually reflected in the numbers, be it, they can actually be believed and realistic and authentic, or really you've got to take them with a pinch of salt. But I think were we to see a nasty surprise with China, which, let's be honest, I think people looking to that country to try and lead the world out of this crisis, bad numbers there could certainly really give the equity markets something of a major clobber. What else we got? I should say, so just switching across to Europe, I suppose it's kind of good news, or it may be a little bit premature, personally thinking, but we've had some limited easing on the COVID-19 restrictions in Austria, Italy, and Spain being announced over the course of the last couple of days or so. This is still very limited. It's just a number of shops and things being allowed to open, some factories also being allowed to reopen, but by and large, the lockdown in general still applies. France has extended its lockdown now until May the 11th, although from what President Macron was saying yesterday, that has now been pretty well penciled in as the date when we will start to see some opening up the economy there as well. But as far as the UK is concerned, it's still very much the case that we're due to get an official announcement this Thursday about the state of the lockdown here, but it seems, virtually guaranteed it will be continued. What we have seen coming out of Europe, which was, I think it's got to be regarded as disappointing. Last Thursday, the Eurogroup finance ministers, they agreed to a 500 billion euro rescue package for those countries hardest hit across the region by this pandemic. Now, it's taken quite a long time to come up with this, and this comes after the ECB not long ago was intimating that it thought we'd need something around about 1.5 trillion or so just to get the ball rolling. So I think it's still really quite underwhelming, and it's not really the first time that the bloc as a whole's been slow to respond to, and more important in this instance, it's kind of failed to grab a real opportunity to show it can act cohesively and deliver in a way that would instill real investor confidence in its ability to deal with a crisis.
Well, what about the ECB? I mean, they haven't really been hitting the gas as hard as other central banks.
They haven't, that's right. They still got room. And the last real measure they made was back on the 18th of March when they had their emergency meeting and decided to introduce this pandemic emergency purchase program, the so-called PEPP. Lots of these anachronisms doing the rounds at the moment. And that added, 750 billion euros to the existing QE package. And it did play around a little bit with including non-financial commercial paper, and it included Greece amongst the potential qualification for the collateral as well. But it's, as you say, at the end of the day, when you start looking at some of these shares compared to GDP, it really ain't that much. And it's interesting, I think, looking at the various European economies at the moment, some areas where sentiment seems to be holding up better than others, the likes of Germany, where they really have a significant fiscal package in place there compared to a lot of the others who are looking across to the Eurozone as a whole, to the EU Commission to come out and do something. But again, it's just a reflection of the fact we've got these national divisions over both monetary and fiscal policy, and the older coronavirus is increasingly exposing them.
So on net then, Europe has done the least in emergency moves compared to North America, compared to China, Japan. At
this stage, I think that's probably fair to say. Although, I mean, on an individual country basis, there have been some significant packages put through, say Germany, Spain in particular, Italy to some extent as well. But the problem, I think, from the investor viewpoint, is that they want to see the Eurozone acting with a harmonious face. It's supposed to be a whole bloc. It's not supposed to be individual countries doing their own thing, because when push comes to shove, the various leaders can't agree. So it's something which I know we talked about in the past, I think, but if we don't start to see some improvement in sort of overall political stability across the region, the harmony side of it, then you're going to kind of wonder what it's going to do to the longer term futures of euro. Can it really be regarded as a sort of safe haven asset? The chances are, well, perhaps not.
Well, let's talk about Germany now. They're the center, or that I guess in France would be considered, I think, the central pillars of the EU. We have a bunch of, and Germany has certainly gained a lot of respect in its virus numbers. Next week we get economic numbers. We're going to get sentiment numbers, both from the business and consumer levels, and several different reports, as well as the April flash PMIs, manufacturing and non-manufacturing. Can we see Germany suffering less? Will it be evident? Will there, how many dislocations are happening in Germany?
A lot. And I think, to be honest, at least, as you say, I think out of Europe this week, there's not really a great deal to sort of, to hang on to in terms of providing a guide to what's been going on during the crisis. Next week, as you mentioned, you'll get the EFO survey. That's on Friday. We'll get these flash PMIs on Thursday. And I think, those two sets of reports are going to be extremely important. Now, for a lot of Europe, we didn't see the lockdown coming in on a national basis until around about the middle of March time. We have had some information out of the likes of the Bank of France, for example, which have actually, looking at their own private surveys of activity, have found a major difference between the way the economy was working over the first half of March and the second half when effectively it imploded. So these April numbers are really going to give us a first look at how this almost European-wide lockdown has been affecting these economies. And I think Germany is going to come out of it very badly, like everybody else. And to be fair, I think people were perhaps a little bit surprised by some of the final March PMI data, because the general expectation was they might be a lot worse. I think, if I remember rightly, we had the composite headline index, so the GDP proxy was 35, which of course is a rotten number, but not as bad as the 30 or even less than 30 we've seen coming out of some countries. And ironically, one of the things which I suppose at least you can try and look at relatively positively, recent numbers out of Germany and indeed out of France, so the two biggest economies within the Eurozone. As far as manufacturing goes, and this, as we talked about so often in the past, has been the real problem for Europe, both French manufacturing and German manufacturing were showing real signs of emerging from recession. And we've had some, put a straight line through the January and February numbers, and it really meant that March would have to be pretty horrible for both if we were not going to see recession come to an end. Now, of course, as it is, because we've got the coronavirus hit, that might have been enough to turn March into sufficient negative territory to ensure another quarter of sub-zero growth. But either way, it does suggest at least that before the onset of the coronavirus, European manufacturing was starting to drag itself up from what has been a pretty poor recession over the course of the last half year or so.
What about the European labor market? Now, the North American labor market, we had a terrible Canadian report last week for March, and that preceded a whole series of enormous declines in U.S. employment. How significant has the labor market dislocation been in Europe?
Well, in terms of the numbers, unfortunately, we don't really have a great deal to go with. The problem with the in particular labour market numbers in Europe, they tend to be quite lagging. So as of beginning of this month, the latest update we've got is still only for February. Now, what you can say about February, though, is actually what came in surprisingly well. In terms of Eurozone unemployment, it fell 88,000. We saw the unemployment rate unexpectedly dropping down from 7.4 to 7.3%. So that's its lowest rate in more than a decade. So it does suggest that, again, prior to the onset of this virus, the labour market, and notwithstanding a number of times we talked about sluggish and disappointing economic growth across the Eurozone, the labour market itself has actually been able to hold up remarkably well. Now, presuming we've got to assume as a result of a lockdown that some of these unemployment numbers are going to start turning up and going through the roof over the course of the next month or so. Mm-hmm. But at least as of February, things weren't looking too bad.
So there's no weekly data on jobless claims like the U.S. Any evidence, anything you can find?
No, well, really, when it comes to this sort of thing, you tend to look at some of these, some of the surveys. So, classically the PMI, see what's happening to, the labour component of that, and that will obviously be one of the leading factors for markets to be concentrating upon next week.
What about the what about the major corporations? Have they been announcing any mass layoffs, anything like that?
There have been some. I mean, a lot of it is just sort of furloughing of staff at the moment, hoping, particularly in the likes of the UK, where the government, to all intents and purposes, is providing 80% of workers' salaries where they've been furloughed, so still effectively got jobs, but the company's not paying them, so the government's forking out most of their salary or wages. You're getting some of that across Europe as well, but a lot of it is, unemployment is going to go up sharply. The particularly particular in the likes of the auto sector, which was struggling very badly even before the virus struck. But likes of the big German manufacturer had been hit badly by the slowdown in global trade, and that was already starting to have knock-on effects elsewhere across Europe. But I think if the labour market, to be fair, across Europe has held up by and large surprisingly well during the last year or so, and we've consistently seen unemployment numbers coming in below what market expectations have been. So tell me your side. Jobless claims, they seem to be settling at ridiculously high numbers. So I would assume there are going to be some seriously nasty monthly employment reports coming up.
Yes, that was the good, but there was actually good news in last week's, because the rate had slowed. I think it was from 6.8 to a 6.6, something like that. I'm just looking right now for the Econoday consensus coming up on the one on Thursday morning. And where is it? There it is. Okay. And right now we're looking at 5.5 million. So it's kind of like the infection rate. It's actually very, very high, but it's coming off its peak. And hopefully that's what we'll see. They're very, very hard to predict, but the last three reports have totaled about 17 million Americans filing for unemployment claims, this being concentrated in accommodations and food services, and also, but the service sector in general. And we've seen that with the PMIs, by the way. If you think about those PMIs that we've been seeing, they divide them up between manufacturing and services. And the service ones, the ones have been taking the huge hits. So in any case, we're going to have, if you compare this, there's roughly 160 million Americans who are employed. So, 17 million in that. I did the behind the envelope kind of thing the other day. Low double digit unemployment rate for, April should be a shock, even how shocking that may be, but we'll have to see. In any case, but I guess we have to start looking forward to the redeployment of this labor force. If it's smoothly, if people go back to work smoothly, if the employers take them on smoothly, if the employers use this opportunity as they might see it to down staff, that this would be a time to do that, and how much new force will be coming in will be part of the recovery story, and how fast these economies can snap back.
Well, too, there's been some a new forecast, which I know we're talking forecasts here, and as you mentioned, some of these figures you can almost take with a pinch of salt because they're just so dramatic that the area of sort of uncertainty surrounding them is huge. But the Office for Budget Responsibility in the UK, these are the guys who are responsible for producing the official budget forecast or target, if you like, that the government tries to adhere to over the course of the fiscal year. Well, they've just updated their numbers now for the first time to include, supposed effects of the coronavirus. And they're assuming what is possibly a reasonable assumption that will be a 3-month lockdown scenario. Now, before the coronavirus struck, they were looking for second quarter GDP growth in the UK, quarter-on-quarter basis, as we do over here, about 0.4%. Which by UK standards of late actually wouldn't be too bad. They are now talking about, under their sort of central case scenario, a decline in second quarter GDP of 35%. With the jobless rate rising from currently, 3.9% to 10%, and underlying public sector borrowing, so the public sector net borrowing requirement excluding commercial banks or privatised banks, nationalised banks, I should say, climbing up to 14% of GDP, which would be the largest since the Second World War. Now, these numbers are clearly just their own estimates, but it does highlight the short-term effect that this virus could have as we get this lockdown coming through and impacting both all the demand side and the supply side as well. What else should I mention? I suppose since we're on the UK, I should just mention there was something new from the Bank of England announced last week, which I think some people have almost misinterpreted. And that was they announced that they'll be extending their Ways and Means facility. And this is the government's pre-existing overdraft at the bank. It's being extended to provide additional liquidity as required as long as this virus goes on for. So effectively, you could say that the bank itself will be, to all intents and purposes, directly funding the government's deficit. However, they're extremely keen to point out that this extension will be only temporary and it shouldn't be seen as a switch to monetary financing of the deficit itself. Rather, it's just a case of a sort of a smoothing operation aiming to limit the potential disruptions to the gilt and the sterling money markets, which is going to be caused, not just in the UK, but in lots of countries, by the sharp increase in borrowing needed to fund the various government's emergency COVID-19 support packages.
But isn't QE itself a de facto financing of the government's deficit?
QE. Well, QE, of course, is put through in the secondary markets rather than the primary market. So effectively, the individual central banks will say, they're printing money, but they're buying stock that's already out there. This is effectively directly going to the government and saying, we'll buy we'll buy whatever you want to sell us. But it's interesting. There's been some discussion, certainly over here, looking at what the bank's doing. So this is all about really controlling the gilt market, making sure gilt yields don't go all over the place. And to some extent, from all the packages that the Fed's been putting through of late, some of it, albeit perhaps courtesy of the Treasury, but does this actually smack of some kind of yield target control a la Japan? And it may be interesting if it actually goes down that route. Now, for a country like Japan, which at the end of the day doesn't have an external deficit to worry about, you can probably get away with it. But for likes of the UK, which has been racking up these current account deficits and sizable ones for such a long time now, the idea of suddenly coming out and say, well, look, we're going to target, let's say, the 10-year gilt yield at 0%, irrespective of whether that's high enough to actually attract the funding needed to fund the current account deficit. Well, that's a different question altogether.
Well, that's what the Fed said in its emergency announcements on expanding QE, unlimited, indefinite, and it could be any group of maturities targeting anywhere. So we don't know, but it's open,
Okay. Right. Okay. I guess we're very long enough. One thing I will just quickly mention, such is the demand now for up-to-date economic statistics that StatCan in Canada, the guys who are responsible for their official economic statistics, they'll be releasing a nowcast estimate of March GDP tomorrow. So that's Wednesday. So that will be a couple of weeks ahead of the next official GDP report, which will only be for February. So very much indication of just how, really policymakers want to know what's happening now so they can make up their policy and adjust very quickly to this coronavirus.
So will we be calling this a flash, you think? What should we be calling this?
Well, let's see if it's, I suppose, effectively, you have lots of nowcasts your side, don't you, from various regional feds?
Yeah, but not from the official statistics.
I say, you're right. I mean, as I understand it, they're calling it a nowcast, and whether this is going to be the start of a regular release or a one-off type thing, I don't know at this stage. It's only just been announced, I think.
It's Q1? Is it going to be Q1?
No, this will be for March because they have their monthly
just for the March. Although we already know January, February. So Canada will be.
Well, see, Canada, we don't. The Canadian official GDP numbers come out quite late, a lot later than the state. I know you have quarterly, but a lot later in comparison from the state side. So as we currently have, we don't actually have February GDP out of Canada yet. But before we get February GDP, they're going to come out with an estimate, a nowcast estimate of what March looks like.
And what are we supposed to do with a database with something like that? Right?
That is a very good question. It needs modifying. Fortunately, we got all these clever technical people who I'm sure will sort that out.
We're listening to this right now.
Thinking, oh, good. Okay, then. Right, on a reasonably jovial note, I suppose, let's round it off there for this week. But to keep up to date with what is happening now, remember, keep checking Econoday's global economic calendar. On behalf of Mark and myself, thanks as always for listening. Stay safe, and we'll speak with you next time. Bye for now.